in this lecture, I'll just be going over some terms which you will frequently keep hearing throughout the course and you will keep using as well. You need to know what these mean. You're basically going to deal in that. So, the first one is event and transaction. Both seem quite similar, right? Yeah. Event, the term event means it is an occurrence or a happening which is the result of transaction which brings change in the financial position of the company. Like, for example, inventory or gross profit. Whereas the term transaction means it's a financial event entered into by the parties and recorded in books of accounts. So, by this definition, all transactions are events, but not all events are transactions. If an event cannot be expressed in terms of money and does not bring change in the financial position of an entity, then it can't be classified as a transaction. For example, resignation by the marketing manager. For example, the marketing manager may resign, but however, the impact caused by his resignation cannot be measured in monetary terms, and the way in which the financial position of the business unit will change after his resignation. Now, for the next terms, assets. Assets are future economic benefits, the right of which are controlled by the organization or the individual. Assets basically help you in earning money. Whatever brings home money helps you in earning more revenue is your asset. Now, assets can be classified into all these types. You have fixed assets, tangible assets, intangible assets, current assets, liquid assets, fictitious assets. Fixed assets are those which are not purchased for sale but rather to expand the earning capacity of the business. For instance, I run a bakery and I have only one display unit with me currently in which I can only display at the most pastries. But if I buy two more display units, then I can also showcase the breads and cakes and maybe cupcakes as well. Now that I have got more display units, that will help me in earning even more money through the sale of my additional products. So in this example, the display unit is a fixed asset. Next, we have tangible assets. The word tangible means anything which can be touched and felt physically. So those assets which have physical existence are termed as tangible assets. So from my earlier example, the display unit, that is a tangible asset. Intangible assets are those which do not have physical existence. So for example, goodwill, trademarks, patents, computer software. These assets can't be touched, can't be seen, but they do have certain impact and they are called intangible assets. Next are current assets. Current assets. These are those assets which are held for short term with the purpose to sell or convert into cash. Example are like unsold goods, debtors, bank balance. Next is liquid assets. Now, these assets are part of current assets and can be converted into cash in a shorter period of time, maybe even faster than the current asset. For example, bank balance, bonds, anything which can be easily converted into cash is termed as liquid. And those assets which can easily be converted into cash are liquid assets. Next, we have fictitious assets. These are those kind of assets which are created by an accounting entry. They don't have any physical existence or any realizable value, but they are actually expenditure. We'll be dealing with this in future. For example, the purpose of creating a fictitious asset is to account for expenses that can't be placed under any normal head. An example of a fictitious asset would be the incorporation certificate. Usually, whenever companies get registered, they require a document called the incorporation certificate. Now, to acquire that certificate, they have to take on certain expenses. Now, those expenses will be classified as a fictitious asset. Next, we have liabilities. The word liability means any amount which the enterprise owes to outsiders or the owners. Now, in the business, transactions are always recorded from point of view of the business. Accordingly, we have internal liabilities, external liabilities, and contingent liabilities. Now, internal liability is that liability which is owed towards the owners of the company. It is also known as capital. External liabilities are those which arise from any loan taken from a bank or purchasing goods on credit, and contingent liabilities. Okay, so external liabilities can be of two types, current and non current. This again depends upon the time period in which these dues are settled. If the liability can be settled within the accounting period, it will be classified as a current liability. And if it takes more than the current accounting period, beyond period or beyond 12 months, it will be classified as a non current liability. Next, we have contingent liabilities. These are liabilities which are uncertain. They may or they may not happen. It depends. The obligation to pay depends upon the happening of a future event. So, for example, a court case has been filed against the entity. If the judgment comes in favor of the company, company doesn't have to pay anything. But if it comes against the company, then the company might have to shell out money, and thus that is a contingent liability. Until the judgment of the court comes out, it is uncertain whether we'll have to pay or no, and that is a contingent liability. Next, we have inventory or stock. Now, stock are those goods that the company sells in its ordinary course of business. Stock, in case of a manufacturing concern, will have three levels. One is raw material, material used in manufacturing the final product. For example, the company manufactures notebooks. So, in this case, paper will be used as a raw material. Next, we have work in progress. Now, these are those goods that are semi finished, they are not yet complete. Paper in my paper factory has been ruled, but it has not been bound. Thus, it is still a work in progress, and I can't sell it, and I can't classify it as a finished good also. Next kind of inventory is the finished goods. Next category. Now, these are those goods that have undergone the entire manufacturing process and they are ready for sale. So, that would be a ruled and a bound notebook, which is appropriately packed. Next, these terms are very commonly used. Expense, the cost of using things or services which will help in generating revenue. Now, what is revenue? Revenue is inflow of cash from the sale of our goods. Income is nothing but expense. Income is nothing but our sales minus our cost. That is our revenue minus our expense. The next term is drawings. Drawings. I have a kirana store and I have invested about 50 lakhs in it. I urgently need 10 lakhs. I really require it. And right now, the only place from where I can remove it is my business. So I removed 10 lakhs from my sole proprietorship, and that 10 lakhs which I withdrew would be called as my drawings. That term is called drawing. Basically, withdrawing the capital that you have invested in the company is called drawing. And capital, I'm pretty sure you know, it is the amount which is invested into the business by the owner. This formula you should keep in mind. We will be solving problems based on this in the next lesson. Capital is equal to assets minus liabilities. We will be dealing with it in more detail in the next lesson. Now, receivables or debtors. This is the amount due from others. Okay. And the people who owe us money, they are called debtors. People to whom we owe money are called creditors, and the amount that we owe to them is the payable. That's all for today. These are some most commonly used terms that we will be coming across. I hope you have familiarized yourself with them, and if you have any doubts, feel free to ask me in the comments. See you in the next lecture.